This is what Tom Lee said ahead of the inflation report that came out yesterday.
I think it's time to get bullish. Stocks really have been consolidating for the last couple of months, and I think the conversation you had is correct. The data has not convinced hawks or doves which way inflation's breaking, and I think once we get a decisive data point, and potentially it's tomorrow, I think that $6 trillion of cash comes off the sidelines, and I think stocks break out of this range. And I mean, that's our bet that, May ends up being a very strong month for stocks, even better than it's been already.
What's this rally about? Why don't you tell me in your own words what you think this is about? Why did we rebound so quickly? And why are we now on the doorstep of a new closing high for the S&P?
Well, I think that markets kind of had a very sort of simple framework in their head, which is as soon as inflation accelerates, the Fed switches from dove to hawk and tries to crush the economy. And I think Powell's been very clear in all of his recent statements that, look, inflation is not just this core headline number, and it's not just a services number. It's these three moving pieces: housing, auto insurance, and everything else. And they've been playing a waiting game. We're seeing that even in some of the recent articles, and Powell talked about it, and a lot of folks are talking about auto insurance. I think once that turns, and it possibly, because if you look at PPI, insurance actually rolled over pretty hard. I think it's going to make it clear to markets that it's not just hey, inflation is stubborn. It's really this: inflation is now normalizing. The economy's in good shape, and rates are so restrictive, the Fed actually needs to cut rates, and that's actually quite good for stocks. Look, if it's a pause, actually it's good for stocks. If it's a cut, I think it's even better.
Well, following the inflation report, stocks have done very well. And what could be coming next is what Tom Lee's been calling for this entire year. Sure, it's taken a little bit longer, yes, but I think we have a perfect storm brewing for small caps. Walmart surges to an all-time high as earnings beat on high-income shopper and e-commerce gains. Walmart's same-store sales continue to fall quarter over quarter, and Walmart says that wallets are stretched. But Walmart did not come out and give a dire warning on the state of the consumer. They say, hey, some people are doing okay, some people are not doing okay, but they're still going out and they're spending. Which the number one thing to be watching for, whether you are bullish or bearish, is how is the consumer doing? Are they spending money? Are they going to drive earnings growth in the S&P, the Dow, the Russell in this year, or are they going to slow down? A lot of people forget 74% of economic activity is dependent on the consumer spending money. So I think we could be entering a perfect storm, for a lack of a better word, for small cap stocks. As the consumer continues to hold in, I don't think they're going to throughout the rest of the year. I think they're going to weaken, and I think that will eventually be bad news for stocks. But until you get enough weakening of the consumer, stocks here could do pretty well. Now, I am not bullish on the S&P and the NASDAQ, okay? It's hard to be bullish on these at all-time highs with stretch valuations and low participation ratios. What I mean by that is if you strip out Microsoft, Apple, Google, Amazon, Nvidia, your big tech names, the markets would be much lower today, right? Just take those stocks out, and markets are going to be like 5 to 10% lower. I don't even have to look at the actual numbers to tell you that. Yes, there has been a broadening of participation in recent weeks, but if you look at PayPal. Look at PayPal. I think that is a great stock to judge what's going on with the broader markets and participation. Okay, now PayPal is also one of Tom Lee's granny shots, meaning he thinks that that stock is very underappreciated. PayPal is a stock that I own, deemed interest rate sensitive and economically cyclical. I think if you look at PayPal, the stock has done basically nothing in a long time, right? Years, essentially. I think a stock like a PayPal, a Fubo, a SoFi, a Tesla, some of these stocks that have not done anything in years, those are the stocks that could start to see the capital allocation that could outperform, aka interest rate sensitive and small caps. That is because as the consumer continues to hold in and the markets don't have this huge negative recession cloud hanging over us, you are in this sweet spot where capital will start to get deployed into a stock like a PayPal, right? The stocks that I just mentioned. And these stocks are I should say, this is the area of the markets I believe can start to outperform over this summer as we start to head in to the first cut by the Fed. Are currently assigning a 26.4% chance of a Fed cut coming July 31st, 2024. 72.7% chance of no cut. Now, I believe we will see a better CPI report coming out in early July or June. It actually comes out the same day of the Fed meeting on June 12th. And although that's not going to prompt the Fed to cut rates June 12th, even if the CPI report is really good, but you'll get 2 more inflation reports by July. And as long as we see this disinflation trend continue with inflation, you're probably setting up for a cut July 31st. Now, the question is, do stocks do well into July 31st? The answer to that is if the economy does okay, right? If the economy does just really bad from now until July, stocks are going to do poorly no matter what inflation does. If the economy holds up and does okay through July and inflation continues to disinflate, that's where you have a very bullish potential setup for small caps and interest rate sensitive stocks really throughout the summer. Okay, if we get the first cut July 31st, I think we'll get another in September. It depends how the economy is doing by November. You may or may not get a cut in November. Now, December, I think you'll probably get another cut as well on December 18th. So I'm looking at least 3 cuts this year, if not 4, depending on how the economy and consumer are doing. But definitely I'm expecting the first cut July 31st. So is Goldman Sachs. Goldman said yesterday, based on details in PPI and CPI reports, we continue to estimate that the core PCE price index rose 0.25% in April. We continue to expect the Fed to cut funds rates by 25 basis points in July and proceed with cuts at a quarterly pace thereafter. Today, Fundstrat reposted this post from Jake on X that says small cap summer. And if you're looking at the technicals, getting a breakout above about that 210 level on the Russell 2000 could lead into a lot more upside, and acknowledging we are now in this trend line from November's lows and then these recent lows that we hit back here in late April, early May, and then, well, we've been rising ever since. You break up out above 210, you could potentially see a small cap summer. And again, I don't think it has to be just small caps. Like PayPal's not a small cap stock. I think it's more so just interest rate sensitive stocks that will do better. CNN's Fear and Greed Index today is sitting at 61, and that is in greed territory. Yesterday, you were at greed as well, but you were at 59. So today, it's looking a little bit better than it even was yesterday. Market momentum is greedy. Stock price strength is fear. Stock price breadth is greed. Put and call options is extreme greed. Pretty interesting. Almost 2 times as many calls than puts. Market volatility is neutral, and safe haven demand is in greed territory. Junk bond demand is also neutral. But again, I really don't like the S&P and the NASDAQ at all-time highs because, I mean, do we really have positive catalyst for the SPY and the triple Qs? I mean, cutting rates doesn't affect or doesn't help big tech. If anything, you can make the argument that it actually hurts big tech, which controls the S&P and the NASDAQ on a headline basis. So I don't think that's a positive. The Fed cutting rates generally is not going to be a positive for big tech unless we get earnings that are going to come in much better than expected, which I don't think is a reality because the consumer is slowing down. Let's be honest. That is a definitive fact. I mean, lower inflation could be just overall good for valuations because inflation, let's say inflation is, 5% a year. Let's just call it that number. Well, over 10 years, that's 50% inflation. Just simple math here, right? Well, if you're looking at a growth stock that's going to do X number of EPS in 10 years, well, that inflation rate, you got to cut that down by 50%, because inflation's 50%. And there's a more mathematical equation that goes along with this, but that's a general practice, right? If you have 2% inflation for 10 years, that's 20% inflation. On a valuation basis, you can assign a longer valuation or a higher valuation to longer term growth companies, which I could see that having a positive effect to the S&P and the NASDAQ. But is that already priced in? Is there already a lot of optimism priced in around that? I think so. I think there's a lot of optimism priced into big tech in general. Most of that, I would argue, due to the revolution of AI. NVIDIA earnings next week will be very important. Can't believe I said tomorrow. Next week will be very important. You do have earnings coming out today and after hours that will be important with AMAT, that is Applied Materials. They are a semiconductor equipment provider as well. And that could give us a little bit more glimpse into AI demand, but I think we have a pretty clear picture right now. Semiconductor demand is strong. It's not egregious, it's not crazy demand, but it is strong still. So with that said, if you are not in cash, if you are allocated to markets and you want to be allocated to markets, I think by far the best place to be is the Russell 2000 by a long shot. But if we do go into a recession, if we do get a steeper slowdown, the Russell is going to get hurt a lot more than, you know, the S&P or the NASDAQ or big tech. So that's kind of the trade-off here. So let me know your take on markets right now. Are you bullish? Are you bearish? Bullish on small caps, bearish on small caps, bullish on big tech, bearish on big tech. Let me know your thoughts down below in the comment section. I have to say though, if you look at the Russell on a weekly candlestick chart or even a daily candlestick chart for that matter, it does look like the Russell could break out pretty big here to the upside over this summer. Let me know what you think down below in the comment section. Like, it looks pretty dang perfect to me. Yeah, you got to get above about 210, but you get above 210 on IWM, and there's a pretty clear run up to the 230s. Could make for a pretty interesting trade. So you guys have a great rest of your day, and I will see you in the next one.